Welcome to the program. This hopefully will be an interesting and informative discussion of life insurance. We kind of maybe build it as a basic life insurance program, but it's anything but basic. And I'm going to actually let Jonathan do a lot of talking, and I'm going to listen and take some notes. And then we'll give you some practical discussions throughout and some more at the end. Before we get started, just a couple of quick points. The PowerPoint's available on the console. If you click on the handout caret, you can expand that and download the PowerPoint. It will also be posted to Shankman Law and ILS, Interactive Legal, and Peak Trust will also have it on their websites. When you go to shankmanlaw.com webinars, there's a growing library of about it says 50. It's meant 150 webinars, and there's about 150 planning video clips on Law Easy as well. We don't give CLE or CPE program, but we do generate a certificate of attendance if you can self-report. We cannot do anything about the certificates. It's all generated automatically. If you have any questions, I suggest you email Jonathan or I directly, and the sponsors' emails are all on the last slide in the slide deck, which you can download. Before we get started, Interactive Legal, we're going to have Teresa Bush give us a word or two on behalf of Interactive Legal.
Absolutely. Thanks, Marty. We're very pleased to sponsor this presentation along with Peak Trust because I think that there are a lot of planning opportunities for life insurance that people are just not familiar with. And I looked through the slides, and as Marty said, we start off with, I think, the basics, but there's a lot of good complicated stuff in here, as well as a discussion of life insurance trusts. And one of the things that we were all addressing earlier, actually last year, was we were concerned about life insurance trusts and trusts in general with potential changes to grantor trusts. And that's one of the things that we at Interactive Legal focus on, is what's changing and how do we need to adjust our estate planning documents and our approach. And so if you're interested in seeing our drafting system, you can reach out for a demo, and we'd be glad to share it with you, because the things that Marty and Jonathan are going to talk about, many of them are available in the program, in the documents that can be generated, and that just is designed to streamline your practice. So again, we're pleased to sponsor this and look forward to an informative presentation.
Let me make another plug for Interactive, but it's also informative to the topic that we're discussing, and we'll have some more comments at the end of the program on it. The spousal lifetime access trusts and variants of it, like SPATs, that all of us created tons of in 2020 and 2021, and obviously in other years too, but certainly during the crush of the planning when people were concerned that all the rules would change. Those trusts as well can have life insurance provisions, an insurance trustee built in, and provide incredible flexibility. If you've created a lot of SLATs and you've not built insurance provisions into them, you may be able to simply decant the SLAT and add insurance provisions in a separate insurance trustee, which may be advisable if the client themselves is an investment advisor or investment trustee, so that they're not serving in that capacity over insurance on their own life. So there's really incredible flexibility well beyond your traditional life insurance trust built into Interactive Legal, and we'll talk about some of that planning in general as we get on. Nicole for Peak Trust.
Yeah, thank you, Marty. Welcome, everyone. We're so happy that you're attending today's webinar. My name's Nicole. I'm a trust officer here at Peak Trust, and we offer a full spectrum of trustee services, serving individuals, families, their trusted advisors. We offer flexible and customized administrative services for all types of trusts. So I invite you to, visit our newly designed website and reach out to us if you have any questions about trust services. Please feel free to contact me. Thank you.
Nicole, before
hey,
you
Nicole,
jump off,
where is Peak located now?
That's what I was going to ask.
Oh,
Nicole.
okay. So we're located in Alaska. That's where our original office was, and then we opened one in Nevada, and we have a state charter in Nevada and Alaska, and then we are opening a new office in Delaware. So more to come on that, but please, visit our website and you can get more details on that, or feel free to reach out and I'll be happy to discuss that with you.
So one of the things that I've often liked to do when I set up SLATs to help address the reciprocal trust doctrine, I'll set them up in different jurisdictions because the laws in each state can be fairly significantly different. The rule of perpetuities in Nevada versus Alaska are quite different. And using different state laws integrates into the trust or pulls into the trust all those differences, which may help deflect a reciprocal trust challenge. So you can create trust in different jurisdictions with different legal entities because Peak is a different entity in each of those jurisdictions while using the same company. It's been my custom to try to feature a different charity on each of the webinars that we do. I think I get that in on most of them. And we're very fortunate to have a very interesting charity that I just learned about myself and really does some wonderful work. So let's hear about it.
Thanks so much, Marty, and thank you to the Shankman team and to all who are joining the webinar today for this time. I'll start with a really basic question, and that is, do you think it's important for children to learn how to read? I can't imagine that anybody would answer in the opposite or otherwise, but if you did answer yes to that, I hope what follows has an impact on you. I'm Naima Bilal. I'm the Chief Development Officer of the Children's Literacy Initiative, and CLI is a 34-year-old direct service literacy organization working in 6 states across the country, impacting 3,500 educators and 70,000 Black and Latinx children. And our goal is that children learn to read successfully. We all know, and it's no secret, that reading level is a determinant of life success. And there's no better way of providing excellent, high quality early literacy instruction. At least the research says there's no better way than providing high quality teacher professional development. And that's exactly what CLI does in 3 ways. One-on-one job embedded coaching, a teacher and a coach inside of the classroom. We also provide workshops and seminars that, similar to this webinar, gives all of the best practice in the field for early literacy instruction. And of course, we provide the books and materials that children need to advance their reading success and joy. And our programs are unique because, unlike most early literacy programs, they're independently evaluated and validated for impact. So if you believe in the power of early literacy to propel a child into a lifetime of success, we invite you to learn more. Visit us at our website. We're at cli.org. Again, that's cli.org. Thanks so much, Marty.
Naima, before you jump, when I was first talking to your organization, and I don't mean to put you on the spot, they gave a few statistics about the number of books in many of the homes of the children that you're helping. Do you recall some of those numbers, because they're pretty shocking, and I think really drive home the point too.
Thank you, Marty. It's a great question, and indeed the statistics are staggering. And what we know is that due to systemic inequities, for every I think for what we would probably most people in this audience are children, and we had access to robust libraries and books in our homes. The average middle class child has access to some 100 books within their home, and that's per child. Now, when you think about Black and Latinx children who are impacted by systemic inequities, that picture is far more stark in that for every 30 children, there are about 8 books that are available. Oh. And so what CLI does is we help fill the gap in between what the systemic inequity has left for families who've been isolated from resources historically, and we provide the job embedded coaching, and importantly, the books and materials. And so it's a really, really vital part of our mission that fuels what we do.
Thank you, Naima. And for all of you, a great cause, and I encourage you all to take a look and see how you can help. Jonathan, I believe you've brought your magic wand to the program today, and we were going to start off by telling about magical things about life insurance.
Well, thank you, Marty. Let me begin by saying I think life insurance is probably the least understood financial product that we deal with. And each of us learns a little bit about it, but I've spent a tremendous amount of time looking at life insurance from almost every angle I could think of. And I hope that we'll bring some important information to you so you can better use life insurance in your practice and in your own lives. There are three kind of magical things about life insurance that may not be obvious, but they're there. One is that the focus today very often is on that tax-free step up in basis because we have such high estate and gift tax exemptions. And we have this conflict about transferring assets before you die to keep them out of your estate and yet having them in your estate so you get the tax-free step up in basis. Well, with life insurance, you don't have to worry about that because even if the insured has never owned the policy, even if the insured has no control over the policy, even if the policy won't be included in the insured's estate, you still get the benefit of an efficient tax-free step-up in basis because under Section 101A1, life insurance proceeds are excluded from income taxation by the recipient. That's just amazing. In addition, we know that if you give assets away during lifetime, you probably do not get a tax-free step-up in basis at death if it's not included in your estate. But Mitch Gans and Hugh Jacobson and I wrote an article in the September 2002 issue of the Journal of Taxation in which we said if it's in a grantor trust, then we think there should be a step-up in basis, despite the fact that it's not in the estate. The IRS got very angry about that and issued Chief Counsel Advisory in 2009 that you see there and said, no, 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 if it's not in the gross estate, you don't get it. But then about 3 years later, they issued a private letter ruling, 2012-45-006, where they said you would get the step up in basis. And indeed, Bernie Sanders, in one of the bills that he introduced last year, said you will not get a step up in basis for assets in a grantor trust if the assets are not included in the gross estate. Well, Marty, of course, the question is, why did Bernie bother with that? If you don't get a step up in basis, even though they're not includable in the estate.
Jonathan, he wanted to make sure to put an end to your planning idea.
Well, and if the bill had passed, that would work. Now, the other thing is that there's almost always a conflict when you're doing estate planning about telling clients, well, you ought to give property away before you die. You can keep it out of your gross estate for tax purposes, and you can also protect it from claims of creditors. But then the property owner says, but what about me? And that's a very common thing. All human beings, other than Marty, of course, are very selfish. But if you've got the typical client who cares more about himself or herself than everybody else in the whole world, they still want access to it. But life insurance is different because in the vast majority of cases, insurance isn't going to do the insured any good during his or her lifetime. Now, we're going to come to one exception there for split dollar insurance where they can benefit from the cash value component of the policy, or at least a portion of it if they want to, without causing it to be in their estate. So you don't have to worry about it. So that's a great thing. And the third thing about life insurance is, of course, we not only worry about estate tax, we worry about asset protection. But one of the things in the vast majority of states, California is the big exception, life insurance is entirely exempt from claims of creditors. So if I have a policy worth $10 million cash value and I go through bankruptcy and I'm a New Yorker or I live in Florida or Texas or Massachusetts or a variety of other states, when I come out of bankruptcy, my creditors can't have taken that policy from me and I can call up the insurer and say, I want to cash in the policy. And I therefore get the proceeds. It's a phenomenal way for asset protection. So those three magical things, a tax-free step up in basis, even if you don't own it, no conflict between wanting to own this asset and benefiting others because you probably aren't going to benefit from it. And third is you don't have to worry about having it subject to claims of creditors. So those are three magical things about life insurance. By the way, I don't sell life insurance, but I know about that, and it can make you feel better when you have a creditor's claim to know that the life insurance you have in at least most states is going to be okay. Now, by the way, if you're in a place like California and you don't get the benefit of an exemption for life insurance, you can put it into an irrevocable life insurance trust, which will provide the protection that the trust does. And even in California, trusts are generally free of creditors' claims. They are spendthrift, and we'll talk a little bit more about that later. Let's go on, Marty.
We're going to also talk about some of the income tax benefits of life insurance too. So that may be a fourth magical thing. And don't misread what Jonathan said, because I think that if you ask Jonathan, and why don't I just ask him? I mean, is there any asset you would ever not put in trust, Jonathan? Is there anything you would ever opt to have outside of trust rather than in trust?
The only things that you will not put in trust, Marty, are where the law doesn't allow it. For example, certain licenses, for example, to say run a nursing home in certain states can't be put into a trust. It's got to be directly owned by the operator. Also,
Right,
it's a position of the Internal Revenues.
No, I was just going to say, but the
position of
default
the Internal
answer. Go on.
Well, and also we can't put a qualified plan or an IRA into a trust. At least that's according to the IRS. They said that will disqualify it, even if it's a grantor trust. Our dear friend Bob Keebler tried very hard to get a ruling to say you could put an IRA and a grantor trust, and since the grantor trust is ignored, you're deemed to still own it. But the IRS threatened to say that the IRA would be disqualified from a tax perspective. Marty, I'm going to talk to you about that sometime. Let's see what we can do. Now, Marty, what are some of the traditional reasons for getting a life insurance policy to begin with?
Well, the most classic is if you die prematurely, you want to have replacement for the earnings you're not earning. So if you have a young family, and this is the classic situation, you buy life insurance to protect a spouse and children from the loss of earnings that you're not going to realize, and obviously to pay debts such as a mortgage if you're a young couple that has a mortgage on your home. Working capital for business, key person insurance, buy-sell agreements, to use to fund an ESOP. I already mentioned buy-sell agreements, to pay income taxes on assets that don't get a step-up in basis, IRD. So if you have gain on death, you can use that. When they were talking in the last couple of years about deemed realization on death, that would have been a significant new use of life insurance, but so far that hasn't gotten enacted, but it may come back again in the future. Flexibility on deciding when to sell assets. Nobody wants to sell a real estate property, for example, at a fire sale to pay an estate tax or to pay other debts or to fund liquidity needs of an estate. So insurance can certainly provide for that. To build sufficient wealth for surviving family members. A classic case of that is in a blended family, where you may want to assure, for example, a new spouse a specific amount of wealth, or you may want to assure children from a prior marriage a certain amount of wealth and not entangle the two to keep things more peaceful and less chance for conflict. Insurance can provide an outstanding solution for that. To build wealth during the insured for a lifetime, and you're going to talk about what you call the blue line, which is just really a reference to one of the charts that's coming up. But insurance can be a vehicle to grow wealth that the insured, him or herself, can benefit from by borrowing out of the policy, to hedge against other estate planning strategies, and we're going to talk about that later. If you have, for example, a tier of GRAT, you do a 6, 8, and 10 and 12-year GRAT. I know GRATs traditionally have been done as 2-year rolling GRATs, but when they were talking about changing the law and eliminating GRATs, some clients, to lock in the strategy, may have done a tier of GRATs, and as you go out longer on the duration of the GRAT, you increase mortality risk. Insurance could be an interesting hedge. So theoretically, if a client did a 6, 8, and 12-year GRAT, you could buy a 6, 8, and 12-year term insurance policy. So if they died in the term of the GRAT and the assets were included back in the estate, the insurance could cover the estate tax or the failure of the GRAT strategy. And that's not a correct statement of GRATs in the sense that it's not necessarily if you die during the term that the full amount is included, but we're not going to get into that nuance here. And obviously, some people, and Jonathan's going to give some very interesting and counterintuitive discussions later on in the program about it, you can use insurance to cover estate taxes and expenses of a decedent. and we'll talk about that. Jonathan, you want to talk about ILETs, and I may jump in and.
No, Marty, you tell us about ILETs. I mean, let me begin by saying, did you ask Marty, is there anything you would not put in trust? But why would someone bother to put life insurance in a trust, especially when it's probably exempted from credit or claims during lifetime?
Well, again, the exception of California, there may be other exceptions as well. But you also, if you die owning incidents of ownership, the life insurance is included in your estate. It kind of defeats the point. If you have a $10 million insurance policy and there's a 40% estate tax, if that policy is included in your estate, you've only effectively transferred $6 million instead of the $10 million you've desired. If you can shift the value from inception, ideally, of that policy out of the estate, then you avoid the estate inclusion, and the full value of the life insurance proceeds are able to pass to future generations. You want to comment on what you mean by discovered later?
Yeah, I mean, suppose you have a policy of insurance that you didn't assign. It's in your estate. And you say, oh my gosh, I want to get rid of that. Well, Section 2035 basically says if you make a transfer of an asset that would have been includable in your estate under Section 2042, which is life insurance proceeds, then if you die within 3 years of the transfer, it's going to come back into your estate. Now, 2035 has an exception. It says, well, if you transfer it for full value, then you're going to be okay. So why don't you sell it for its full value? Well, there's a case out of the 10th Circuit called Allen, decided in 1961, where a woman had retained an income interest in a trust, and when she got very old and gray, as I am now, her lawyer said, Susie, you shouldn't own this policy. Let's get rid of it. Why don't you sell it to your family members? And she did that. The value was quite small. She died within 3 years, and the court ruled that you can't defeat the 3-year rule by selling it even for full value. Now, the case has been criticized, but it's out there, so you're going to have to try to avoid that. And indeed, there is a 94 private letter ruling we have there, which says if you do sell a life insurance policy for its full value, and you die within 3 years, it is going to come back into your estate. Now, what is the full value of a life insurance policy? That's kind of an unknown. The regulations under Section 2512 tell us that it's the, quote, interpolated terminal reserve, which is the amount that the insurance company has set aside on its books to pay for that policy. So if you have a 50-year-old in good health, they're going to set aside a lot more for $1 million death benefit than for a 70-year-old who's in poor health. And the insurance companies generally will tell you what that is. But don't think that's the end of the line, because very often we've had these so-called viatical settlements or sale of policies during the insured's lifetime. So it's not entirely sure. That Pritchard case, which is cited there, says if death is near, then the fair market value or the tax value of the policy, it's going to be the face amount of the policy. Now, were you going to have gain recognition? Well, the best thing to do under current law is to sell it to a grantor trust so you won't have any gain recognition. But otherwise, you do stand a risk of doing that. Now, maybe you can sell it for an AFR note and you won't have any incidents of ownership. But obviously, the best thing to do if you decide to get a policy of insurance, or your client does, is to have it acquired by the trust that's not in the client's estate. So the client doesn't have an interest which would cause it to be includable in her estate, say under Section 2036, because she controls the beneficial enjoyment. But also keep in mind that the touchstone for inclusion of life insurance proceeds under Section 2042 isn't the retention of a benefit from it, it's control over any so-called incident of ownership, which basically means any benefit, any control, very, very broadly defined, and we don't even have a clear definition. But the best thing you want to do is to have a trust in which the insured completely walks away. But we'll come back later on. Suppose the insured wants to get at the cash value of the policy. How do you do that when you want to keep the proceeds out of his or her estate? So let's go to our next. Oh, gift tax consequences. Yes. One of the benefits of life insurance, if you give it away directly, there's no question it can qualify for the annual exclusion. For a long time, there's a question about whether you could get the annual exclusion for the transfer of a policy to a trust, or if the trust owned the policy for the payment of premiums on the policy. Well, there's a case out of the Ninth Circuit in 1968 called Crummy versus Commissioner. And even though the name is Crummy, it's a great case because it told us how we can use the annual exclusion for gift tax purposes. And for most of our clients and most of ourselves, we don't use that $16,000 annual exclusion. And in fact, you know, if I'm married and I have, say, 3 kids or 2 kids and a grandchild, I've got a total of 4 annual exclusions. And that means I can transfer up to 4 times 16. I think that's 64 right now, $64,000 a year. I personally hold back about $1,000 for each beneficiary because I still buy them holiday presents and birthday presents and take them on vacations. But you can do at least $60,000 a year, which pays for an awful lot of premium. And if you're married, your spouse can gift split on the gifts that are not to himself or herself, which would add obviously another $48,000. So we're now up to about $100,000 in premiums that can be paid each year under the benefit of the annual exclusion. You still preserve your full exemption. Now you do get into questions which we're not going to go over. Well, should I allocate GST exemption to this life insurance trust? Well, that's a complicated matter and we're not going to touch it in detail today, but it is something that needs to be considered.
We're going to pick that back up at the end if we have time, just in the context of using exemption that may otherwise disappear in 2026. Just a quick comment on crummy powers. For a lot of clients of more moderate wealth, it may be simpler and easier for them to simply make a larger gift one time to a trust and in effect prepay the next 2, 3, 5, or even 10 years of annual gifts, use up a lifetime exemption that they wouldn't otherwise use. It's going to drop in 2026 and avoid the need for annual gifts and crummy powers for a number of future years. Direct payment of premiums, Jonathan, are you referring to the client paying premiums directly on a policy held in a trust?
Yeah, I mean, a lot of people for a long time, and I was for a while in this camp, that in order to get the benefit of the crummy case, you had to pay the premiums to the trustee or the premium amount to the trustee, and the trustee would then do it. But case law has developed, no, you don't. You can pay the premiums from inception directly to the insurance company, even though it's held by the trust, and it will qualify for the annual exclusion. And there are ways in which if you...
Wouldn't that concern you from a creditor protection? Wouldn't you prefer to make the gift to the trust and have the trustee pay the premiums since the trust owns the policy, even if it works for crummy power
Marty,
purposes?
Why is that, Marty? I'm not sure. And by the way, this goes to show this is completely unrehearsed because I'm not sure what Marty means. What do you mean, Marty?
If the trust owns the policy, wouldn't it be preferable for the trustee to pay the premiums? It just seems to be more consistent with the plan of what we have.
Well, Marty, you and I can debate that sometimes. I'm not sure. I mean, you're making a transfer unless it's a fraudulent type transfer, whether you give it to the trustee or you pay it to the a premium to the insurance company on behalf of the trust. I think it comes out the same way for creditors' rights purposes. But if you feel it's better to do it over to the trustee, go ahead. But again, one-stop shopping is pretty important. So you get the notification from the insurance company that the premium is due. You just send a check back in the envelope to the insurance company, and it's on behalf of the trust. I don't think you have to do anything special about, having the money available to the power holder for a while. For a long time, people thought that, but I think you can make direct payment of the premiums to the insurance company.
I prefer to do it through the form of the trust, but we'll debate that another time. You wanted to comment
hanging
on
powers, Marty?
Sure. Well, if you make it, go on.
Remember what you try to do. You're making the gift to the trust, which is all great. It means it's protected, presumably, from the beneficiary's claims of creditors, but Is it going to be in the beneficiary's estates because they have this power of withdrawal? A power of withdrawal is a general power of appointment, and that means in all states other than Alaska, it means it's going to be subject instantly to the claims of your creditors. So that's not such a great thing to do. And it's also going to be in your estate because you have this general power of appointment. And Section 2041 says if you hold the general power of appointment, the assets are going to be includable in your estate to the extent of that power of appointment. And if you have had that power within 3 years of your death, normally that's also going to cause inclusion. However, and the problem is that under Section 2514 and 2041, you can have a power of appointment lapse, not up, but lapse by its terms, and that will not be considered a transfer by the power holder for state and gift tax purposes if it falls under either 5% of the assets in the trust or $5,000 each calendar year, whichever is greater. But I want to pay larger premiums than that. I can say put 15,000 comfortably in for each of my children. That's 3 times the amount that can lapse tax-free with respect to them under Section 2514 and 2041. Well, Dick Covey came up with a great idea. He said, let's have that excess amount just hang around. We won't let it lapse, so we won't have a gift made. So I give the trust 15,000. I say my daughter can withdraw the $15,000, but I'm going to have it lapse at the rate of $5,000 a year. Well, eventually I'll probably stop paying premiums. And even if now, let's say I've gone 10 years of letting the extra $10,000 or whatever the amount is hang there, that's $100,000. But now we can begin to have that lapse at a rate of 5% or $5,000. And by the way, over time, the 5,000 may be greater. So you can have that happen. The hanging powers are just great. As Teresa Bush was indicating, we have very, very many choices in wealth transfer planning and the ILS forms for that. Now, generation skipping, transfer taxation. Yeah.
Yeah, I think with the more common use of these robust slats to hold life insurance, where clients have made multi-million-dollar gifts, the 15% is going to far exceed the $5,000. And that may change the calculus of the hanging powers for the good. So just keep that in mind.
Absolutely correct. Now, I mentioned a lot of complications as to whether or not you should or should not allocate generation skipping exemption to a trust. I've written a couple of articles on that. If you're interested, we can get them to you. But one of the things that you can do is to allow cascading crummy powers. Now, this is kind of a difficult concept, and we have an article on that, and this is also built into our forms. Let's say I have 3 people involved in my trust, my wife and 2 sons, as I do. So I give each of them crummy powers, but my son now have hanging powers, and I want to get rid of them. So what can I do? Well, what I can do is to have my wife get a cascading power to the children with respect to hers. So when my wife, could withdraw $5,000, but I put, say, 15 in for her, I say that extra amount, once she's had her 5,000, her opportunity 5,000, the extra amount, the 10,000, is now going to be treated as though it's transferred to our children. So each of them will get their own power of withdrawal, their own crummy power deemed to come from her because she let the entire 15,000 lapse. Well, she allowed 10,000 more than the $5,000 safe harbor under Section 2514 lapse. So she has now made a transfer of $10,000 to the trust. But what she's going to do is basically provide that each of our sons now can withdraw $5,000 each, which now means that can lapse again with respect to her. And now we don't have anything with respect to my wife's hanging power out there. So we have forms to do this. It's called a cascading crummy power. It cascades from me to my wife, and then from my kids to either their brothers and sisters or to grandkids. It's a way to basically expand the use of annual exclusions without the necessity of always having a hanging power. So that's a complicated matter. It's worth knowing about. Now, Marty, do I have to give people notice that they have these rights to withdrawal?
Well, we haven't rehearsed this, and we may have a somewhat different view. Um, we all had thought for a long time that you had to give a crummy power notice, and we all have the ritual of having the trustee give a written notice to each beneficiary and having it signed off. But based on the Turner case, it seems like you don't need to have that written notice. And the written notice did not appear in the original crummy case. It just was sort of created after the fact. Do you want to comment, and then I'll give my somewhat different perspective?
Yeah, the IRS in Revenue Ruling 81-7 said if you didn't give notice of the right to withdrawal, then the right of withdrawal was illusory and wouldn't be respected for tax purposes. So everybody would run around making sure that they gave notice, which is certainly a pain in the neck. Now, in my practice, what I did was when we were going to sign the life insurance trust, I'd have the spouse, I'd have the kids and the adult grandkids come in, give them all a copy of the trust and say, go to page 17, you'll notice you have this right of withdrawal. Now, the patriarch or matriarch hopes you won't exercise that power, but you have an absolute right to do it. And we want you to know that we're intending to make additional contributions, but we would like you to waive your right to get those notices. Now, we may still give them to you. You're not giving up your right to withdraw. It's just you're giving up the right to get a notice every time a premium is paid. Because if you have 4 different policies, you may be paying them at various times during the year. What a pain in the neck to say that the trustee or the grantor or somebody has to give notice. Well, the Turner case said, no, as long as they have the power and it's real, you do not have to give notice. And I'm not saying that you rely on that, but man, is it a nice backup. So, Marty, do you have an alternative view on that?
No. I think that's the key point. You want to keep Turner in your back pocket. I recommend giving the notices if you can. Anyhow, one of the points I was going to make is if you're going to intentionally not give notices, and that's probably because the clients find it incredibly annoying. Take a look at the terms of the trust. If the trustee is obligated under the terms of the trust to give notice, even if it's not required under Turner to do, you still have a responsibility for the trustee to do it. And the answer to that may be yes, and you may want to still do it because of that and only use Turner if there's a challenge from the service. So you may want to just be careful about not doing it. And I think the way Jonathan phrased it is the correct approach. Give the notice, try to give the notice. If it's missed, you still have the Turner argument. Jonathan, you want to talk
Right,
about
and yeah, and well, the trustee again can always ask for a waiver. Say, yeah, we know the trust says you give us the notice, but we're waiving it. Trustee can still give it, but if it's missed, and I would guess in 90%, maybe 95%, maybe 99% of the cases, the crummy notices aren't all given, and the Turner case gives you a very, very good backup position. Fallback marital deduction. If you're married and you care about your spouse, I mean, it's not just a policy for your descendants, then what you want to do is to provide that to the extent that any of the proceeds are includable in the estate and held in the trust, then to that extent, the proceeds will go into a marital deduction trust. And I would recommend a Q-tip type trust because then you can decide how much you want to have it qualify for the marital deduction, how much you don't. By the way, if it's been more than 9 months since the policies with a premium there too have been paid, you can't make a disclaimer because it's an irrevocable trust and your gift has to be disclaimed within 9 months of the time the gift is made. But by having it call into a marital deduction, which is in the form of a Q-tip, if you don't want to have it qualify for the marital deduction, which would cause it to be in the estate of the surviving spouse, you simply won't make the Q-tip election. Let me say one other thing about it. Why would you want to put the policy in a trust? Well, think about the following. Let's say there's a policy on my life and I give it to my daughter, or I give name her as the beneficiary, and I give the policy to my daughter to keep it out of my estate. My daughter dies. Now, I would want the policy to be owned by my grandkids or the proceeds to go to my grandkids, but she, the foolish girl that she is going to despises me. Now, how comfortable am I going to be noting that my hated son-in-law now of insurance on my life, and he will benefit great, owns a policy by my premature death. You don't want to go there. You want to make sure, it's one of the reasons we always put property in trust, that the assets are going to flow where you want them to flow, and no one will have a great incentive to see you reach an early demise.
Just also keep in mind, folks, that if it's a non-citizen spouse, Jonathan, you may want to have a QDOT for your savings provision, not a Q-tip. Jonathan, I think you froze.
Well, no, I didn't. I mean, what's our next choice? So yes, who are you going to choose as trustees? Well, most people don't know an awful lot about life insurance, and I'm one of those. And trustees have been basically threatened, if not sued, because they bought the wrong policy. There was one case out in Chicago where the insured with the insurance agent go to the lawyer for the client, and the lawyer said, well, we're going to put it in a life insurance trust. And they wound up, the client said, well, I'm going to make the lawyer my trustee. Lawyer says, fine. And the lawyer then, because he doesn't want to have to wait 3 years or anything, says, give me the money. I, as trustee, will buy the policy. So they give the lawyer as trustee the money to buy the policy. He buys the policy. Lo and behold, a year later, the client dies. And of course, the policy paid many, many times what the premium was. You'd think everybody financially is very happy. Oh no, the family sued the lawyer. Why? Because they said you should have bought a different policy with a higher death benefit. Now, the case was settled, but it was very, very upsetting to the lawyer, needless to say. If you are going to have a life insurance policy in the trust, make sure that the control of that policy, its acquisition, the responsibility for paying the premiums, whether it will be kept or not, is not made by a third party who could be sued, like a brother or sister or a lawyer or an accountant. Make it a family member. Because if this guy had named his wife as the trustee for life insurance purposes, then you wouldn't have to worry, because she's not going to wind up suing herself. Or if it's the wife who's insured, you make the husband as the trustee. And in fact, in the wealth transfer planning forums, we have an ability to name an insurance trustee. So all of the responsibility for the policy, acquiring it, keeping it, paying for it, turning it around, selling it, trading it, annuitizing it, whatever you're going to do with it, falls on that trustee who's going to benefit from it. It won't cause it to be in his or her estate. They're doing it as trustee. And that's very, very important. I would never again, and I've done it before, act as the trustee of a life insurance trust where I had the responsibility for the policy. So that's something to mention when your client comes in to say, let's choose somebody safe, someone who, if we haven't chose the very best policy, something terribly arguable, we can go ahead and say, no worry, because we're putting it on the family member who might bring the suit.
Let me just elaborate, Jonathan, because I think that's really important. And for those not familiar with the ILS drafting, what it provides for is you can name a general or administrative trustee. You can name an investment trustee, for example, for family business interests, but you can name a separate person, which could be called an insurance trustee, to serve as the trustee for insurance decisions. And that's powerful, not only for the reasons Jonathan said, but let's say a family member wants to be involved in the decisions relating to a family business. It may be a different person, different family member that may be involved in the insurance decisions. And one of the reasons you want to carve that off of, let's say you use an institutional trustee to get situs in a trust-friendly jurisdiction, you don't want to have the institution have to go through the process necessarily of approving the insurance, which they would do if they're named trustee. And this way, if it's an individual, like a family member, you can still get situs in Nevada, in South Dakota, wherever you want for a trust-friendly jurisdiction, and not have to have the institution make the insurance decisions, which you may have already made. So there can be a lot of advantages. And the final comment is, all that being said, since the title of the slide is Building an Effective Insurance Trust, the way to keep an insurance policy and an insurance trust effective is to make sure the policy is monitored. So whoever's the trustee in charge of the insurance decisions, especially if it's a family member, be certain to guide the clients to tell that trustee, that person, that they need to meet at least annually and have the insurance policy reviewed and monitored to make sure that it's performing as it should be. Second to die or survivorship policies are often held in a joint trust where both spouses are the grantors. I'm going to leave it to Jonathan to comment and explain about why survivorship insurance may be less optimal than a policy on a single life. But when you have these joint trusts, and they're very common, very commonly done, one of the issues becomes what happens after the first spouse dies. Is it a grant or trust as to the surviving spouse? In part, how much? And what do you do when premiums continue to be made? Will the premiums continue to be made? You run into a lot of complications and problems. Jonathan?
Marty, that's true. We have an article about thinking about second to die or survivorship policies. Some insurance companies call them survivorship policies because they didn't like the word die in it, but everybody calls them second to die, which is just fine, no matter what you call them. But I urge you, only have one grantor, because the flavor is going to change when one of them dies, and you just don't want to be there for that. If you want it to be a grantor trust with respect to the survivor, it can be, because that's going to be the sole grantor. So even if it's a second to die policy, I urge you to have only one grantor in there so you can deal with it more effectively. In addition, second to die policies look so good because the premiums are so much lower. But actually, on a study I did many, many years ago, they are not cheaper than a regular policy. In fact, the vast majority of policies that are second to die ones actually are dropped after the first spouse dies. So let's you have, say, Marty and Patty have a second to die policy, and let's assume that Patty is the big breadwinner in the family. If Patty dies first, number one, the premiums may go way up because now we only have one insured, so there's a greater risk of death. Even if you have level premiums, because Patty was the major breadwinner in the family may not want to go ahead and expend all that money to keep the policies going. So I think you're better off in almost all circumstances getting a policy on one spouse only, or a separate policies on both of them. Second to die policies look great, taste great because premiums are cheap, and everybody hates to pay life insurance premiums, although we're now going to come to something in a little while to show you how you can reduce the cost of premiums. But again, don't use a joint trust with two grantors, and really consider not using a second to die policy.
It's very true what Jonathan said. The lower premiums are seductive, but that doesn't make it the better decision. We're not going to belabor the changes in Congress. We've talked about those in prior webinars, and right now it doesn't look like anything's going to go through. But there was talk, Bernie Sanders' proposal capped crummy powers for trusts to 2 times the annual gift exclusion, which, as Jonathan said earlier, is now $16,000. They had talked about basically eliminating grantor trust, so any contributions to grantor trust after date of enactment would have tainted part of the trust as being included in the gross estate of the donor, which would have completely torpedoed insurance trust as we know it, and we all had contemplated doing or how to structure a non-grantor ILIT. All that seems to be by the wayside, but you never know, and you never know when it may come back. But for now, I think we're out of the woods on that. Jonathan, you want to explain to many people's surprise why?
Life insurance, as I said, is a very misunderstood asset. And I'm going to go back and talk about insurance in general. Everybody on this call has household insurance, you have car insurance, you have theft insurance, fire insurance, probably malpractice insurance. All of those are term policies. In fact, one of my great epiphanies when I began to practice was to finally realize that a term policy meant that the policy was going to last for a certain period of time, or a term. And in fact, you contrast a term policy with a whole life policy, which is going to last for the person's whole life, at least in theory. But almost all insurance you have works the following way. You pay a premium, you get coverage. If the event you do not want to happen, like your house burning down or the car accident, If that event you don't want to happen occurs, then the insurance company pays. And indeed, at the beginning, back in the early 1800s, when the Brits came up with the concept of life insurance, they called it death insurance because it paid when that event you didn't want to happen, death occurred. But it was a bad name, so they switched it over to life insurance. But when you think about it, it's really death insurance. Like fire insurance is where you have a fire. Accident insurance is where you have an accident. But that's a marketing thing they did. And it works this way. You pay a premium, you get a certain benefit. If event you don't want to happen, whether it's a fire or a death, doesn't occur, the insurance company keeps the premium. If it does occur, the insurance company pays the benefit. But the problem with life insurance, unlike your car insurance, because if you have car insurance, let's say you have a policy with Allstate. Well, if you have a bunch of tickets or you're in an accident, either Allstate is going to raise your rates or it's going to not insure you at all for that kind of thing. Well, as you get older, every year there's a greater chance you'll die. So the insurance company, once you have bad health, you get to a certain age, isn't going to want to insure you anymore. So what the insurance industry did was it came up with renewable insurance. And let's go to our next slide, Marty, and it works the following way. You have your level death benefit, $1 million, $500,000, $9 million, and you'll notice that I've shown the premiums going up each year. And that's because as you age every year, there's a greater chance that you will die. So the insurance company, in theory, and they cover this in a lot of ways, has to charge you a greater premium. Now, you've all heard of level payment premiums, where you get a 10-year or a 20-year policy. And, but that's where they keep the rates at the same rate. But what you do is you're paying more in the early years because you're paying less in the later years, but it sells better. Now, cash value or whole life insurance works the following way. You pay a flat premium typically, and you'll notice that we have two things that go to the face amount of insurance or the death proceeds, that top broken line. You'll see that the pure or term insurance starts at the beginning to be very, very high, and it drops off when the policy, quote, endows, close quote, to zero, and the cash value builds up. And the sum of those two lines at any point in time, the amount of term insurance being paid and the amount of cash value in the policy, which will then be paid, always equal the face amount of the policy. That's a classic traditional cash value whole life policy. Now, notice it says when the policy endows, and now I've got to tell you about my client, Mr. Goldberg. When I was a young client, I had a wonderful client from Connecticut named Mr. Goldberg. And Mr. Goldberg called me one day and he said, Jonathan, the strangest thing has happened. And I said, what's that, Mr. Goldberg? He said, I got a check from my insurance company in the mail today on my life insurance proceeds and I'm still alive. And I said, well, did anything extraordinary happen? And he told me, well, just last week I turned 100. And I'd never known anybody at that time who was 100 years old. So I said, well, don't cash the check. Because I knew, even though I knew very, very little as even a lawyer, I knew that if you were paid more from a policy than the amount of premium you paid and you were still alive, there was income on the difference between the premiums paid and the amount you got paid. So I said, don't cash the check. And I called the insurance company and I told them the problem. And I said, is there any way we can give this back to you? We don't have to accept the proceeds. And the guy said, I'm sorry, Mr. Blattmacher, all insurance companies have a maximum age they write insurance. For us, it's 100, some it's 95, some it's 90. But because Mr. Goldberg turned 100, we have to pay it to him pursuant to the terms of the policy. But he said, I've got very good news for you. And I said, what's that? He paid us more in premiums than the amount of the debt, the proceeds we're paying him now. That was the good news. But news. Be that as it may, Mr. Goldberg didn't have a problem, but it shows what can happen. Now, today, by the way, you can get extended life riders. So you never have to accept the proceeds. They'll give you, after age 100, they'll give you $1 of real insurance, which will keep it being a policy of insurance. So when you die and you get that $1 worth of term insurance and the balance is just build up cash value, it will all come in as life insurance proceeds and be excluded from gross income in most circumstances under Section 101A1. Now, there's something also called universal insurance. Now, all of you have probably gone to a gym and used a universal weight machine, where depending upon the kind of exercise you want to do, you take the pin and you put it in for a different level of weight. Well, that's kind of the way a policy that's a universal policy works. And you'll notice that what I've shown here is the first couple of years, the premiums were about the same, then they've dropped off. You have a lot of flexibility in paying the premiums. But what you do is the sum of the cash value and that heavy broken line that goes across the page is the pure death benefit. That's the pure term benefit. That always remains the same. And when you die, you get the sum of the cash value that's there and the term component. So as the cash value goes up, the amount that will be paid at death is the same. And the beauty here is that the IRS has agreed that the amount paid under a policy, even if it's cash value, which has never been taxed, comes in entirely tax-free under Section 101A1 as a general rule. Let's go to our next illustration, Marty, which is something I think people might be interested in. Well, what is life insurance? Well, that's a very complicated matter, and if Marty will go down, there's a long history to life insurance. There were some abuses, and finally Congress passed Section 7702, which provides us a definition of life insurance and provides some of the tax treatment for life insurance. And let's go on with one more, Marty. There's a little bit more, but we're only going to cover some of it. Now, this is, go to our next slide, Marty. In order to meet the tests under Section 7702, which are complicated actuarial tests that I don't really understand, even though I was a math major, the insurance company will look this over and they deal with the Treasury on this. But what they've done is they said, well, okay, we will have this $2 million policy for a 46-year-old. Now, this is actually mine. When I was 46 years old, I got this policy, and I wanted to know what was the maximum premiums I could pay and what was the maximum cash value it could grow to if I went ahead and wanted it to grow for a while. And you'll see that the biggest premium I could pay essentially in year one was $478,000, and eventually it dropped off to about $100,000 a year. And the maximum cash value, as you look at the right column, it's pretty good. And in fact, even if you go to year 20, I had wound up paying under, about $2 million $2 million in total premiums, and it's worth $10 million. Well, I would have earned at least 17% a year. Now, if you have a policy that performs that well, a couple of things will happen. Either you will have to have cash value taken out, or in most cases, the insurance company will guarantee to pay you more life insurance so you don't violate these actuarial tests. But I wanted to get in as much as I possibly could get in, and we'll come soon to why I wanted to do that. Next slide, Marty. Yeah, now, let's suppose you're the kind of person who doesn't really enjoy paying life insurance premiums. Marty, do you enjoy paying them?
I look forward to it. It's really one of the great joys in life. And I can tell you that
Marty,
clients hate it, and they hate crummy powers. They hate both things.
Yep. Well, suppose we could make the life insurance premiums income tax deductible. Well, that would be good. Now, you can't do that except in some extraordinary cases involving business. But here's the way you can do it. You put in enough money, and this is, again, an illustration that worked for me. I paid a premium at the beginning of $108,356, and I assumed I would earn 7.5%. Actually, I didn't earn quite that much. But at 7.5%, you'll see what the projected earnings on the cash value would be. And to the right, you'll see what the cost of term insurance would be. Now, except in the first year when we had fees and commissions and stuff, you'll notice that each year the amount of the term insurance went up. Why? Because I was older. And that meant that the insurance each year cost more. And if I wanted this insurance for 20 years, I would have to pay a total of $183,547,000. Well, if I was going to have to pay $183,000 and I was in a 50% income tax bracket, I'd have to earn twice that amount. I'd have to earn $366,000 of income, pay half of it in income tax, and be left with $183,000. But if instead I took the earnings on my cash value inside the policy, and you'll see what that is, you'll see that I will have paid all of the premiums other than the first year, but I would have paid the year the 4266, the 4636, all the way to the last year, 16016, with income earned side the policy, and it will never be taxed because I put in 108,356. The policy is going to have a cash value at the end of 20 years of 108,356. I can cash it in. I have no gain or loss. Basically, what I've done is to use pre-tax income, which will never be subjected to tax, to pay my premiums, which in effect makes them income tax deductible. Now, this is something that I began to do for myself and some of my clients. I've written about it. I don't know anybody else who does it, but it is really a super idea. Now, one of the most important things in the world is tax-free compounding. And when you're inside a policy of insurance, the growth is tax-free. And this is a chart which you can look at, but it shows that even if you wind up only having 97% of the amount that you pay over to the policy in there earning money, because there are insurance taxes and there are fees, and even if you don't earn, your full, say 10% in this hypothetical, but only 9.5% because the insurance company is charging additional fees, you can go ahead and have an enormous amount. In fact, if you start with $100,000, you put no more in, and it's earned inside the policy of insurance. In 40 years, maybe the standard life expectancy, what is that number, Marty? $3.6 million. Now, that's amazing to me that I had 100,000 and it grew to 3.6 million. That is the power of tax-free compounding. And the only place under the American tax system, at least I'm aware of, where you get true compounding is with life insurance. You can also get it with a Roth IRA, but that's the only exception. And of course, you're limited with a Roth IRA. So this way, you can basically have whatever you want is effective. Now, this is a chart which shows you how much that tax-free compounding is worth. The red line is what we had before 1900, where nobody paid compounded interest. You earn that 6% on the amount you originally deposited year after year after year, and nobody thought that compounding was very important. The yellow line is taxable annual compounding, which shows you get many times more. But take a look at the blue line. That's tax-free compounding. And everybody wants to ride the blue line.
So, Jonathan, why would I not want to buy life insurance to pay estate tax? And if in doing so, why wouldn't I want to get the biggest policy to cover tax? So if I have a $100 million estate, buy a $40 million policy.
Well, that's what will happen. If you have an agent come to you and says, Marty, Marty's wealth, but Marty has $100 million. The agent's going to say, Marty, you need 40 million. In fact, because you now live in New York, Marty, you need 50 million of life insurance. And so Marty says, okay, that way I'll pay my taxes. But you got to remember what's going to happen. Number one, Marty's wealth is probably not going to grow. Let's assume it only grows at 7% a year. Well, that means it's going to double every 10 years, which means in 20 years, it means that his 100 million will grow to $400 million. It will double from 100 to 200 in 10 years, and from 200 to 400 million in 20 years. So Marty, how much insurance are you going to need to pay your estate taxes when your wealth is 400 million?
A lot more than the 40 I was buying initially, probably 4 times that.
Right. Well, remember, Marty, unless you move to a non-estate tax state, you're going to have 50%. Who knows what the changes will be?
I need 200 million, not 50 million. 4
That's
times
right.
what I originally
When
bought.
But when Marty gets old and gray like I am, and he goes to the insurance agent and say, well, I need more insurance, the guy's going to give him 2 notices that are not very good. Number one, he's going to say, well, Marty, I hate to tell you this, but the insurance is now, because you're an old guy, is going to be a lot more expensive. And if Marty has a health issue, he's not going to get it at all. But now he's got to buy 4 times more insurance, and it's going to cost him more. And he will get to the point when you get super rich, you just can't buy enough insurance. That's a problem. So one of the things that means is you can't rely on insurance alone to take care of estate taxes. You have to do alternative planning. Don't think it's going to be there. Second is all those premiums that Marty has now paid for wealth, maybe in a way to keep it out of his estate. So the bottom line is, and we have an article on this if you'd like to see it, is you want, Marty, let's go to our next slide. What you want is not the policy which provides the biggest death benefit, but actually you want the policy that provides basically the smallest death benefit for the cash value, because you want that cash value to grow. And in fact, if you keep a policy of insurance beyond the age of about 85, it's going to turn out to be a very, very poor investment. Why is that? Well, if I buy a policy on the same day Marty buys a comparable policy, and I hear my family is going to get an enormous return. They pay, say, $50,000 in a premium, and they get a $1 million payout. They've now got 100-to-1 return in a year. Absolutely fantastic. But Marty didn't. Marty lives for a long, long time. Well, because I got such a high return and the insurance company has to make money, it means those who live longer are going to get a lower return. And that's extremely important to think about. So once you get above age 85, the benefits of a life insurance policy are going to diminish because the return on premiums paid will have nosedived. Let's go, Marty, out a couple of slides.
Just a quick comment, Jonathan. I added a comment here. There's some interesting statistical data that people that buy large insurance policies are, if you will, self-selecting, that they tend to live longer because the people buying large policies tend to be more educated and wealthier and take better care of themselves. So they will tend to outlive even the life expectancy tables, which further exacerbates the problem that Jonathan suggested, that longevity makes it difficult. You want to keep going to another slide, Jonathan?
Well, let's go to the chart I have here. And one of my colleagues at Pioneer Wealth Partners and I, Mark Pasquale, and I did this, and it compares basically a level payment policy with a guaranteed death benefit policy. You'll notice that the middle one, you always get the same death benefit. Whether you die at age 51 or die at age 100, you're always going to get $22,000. You might think, well, that's got a policy I want, because you know, if I die soon, I'm going to get 22 million, but you're also going to get 22 million 50 years later when it's worth a lot less. Probably the best thing you can do is to choose policy C, which has a very, very low cash value, but it has a guaranteed death benefit. You might think, well, that's got to be the best, but take a look at the first policy A. This is where the cash surrender value grows, and as you age, it grows as well. And you'll notice that the total death benefit will be biggest then as well. In fact, by age 85, you get more in death benefit from this kind of policy, which Mark and I recommend, which is a low death benefit, starts at only 14 million as opposed to 22 or 25, but it has the highest cash value later on in life. And one of the things that can be done, for example, at age 90, the cash value is 24 million, whereas with the one where you have the maximum, they have the level death benefit, it's only 16, and the other one you have no cash value by age 85. And what you do is be in a position that when you decide that the policy of insurance is not a great investment any longer because your health is still good, you want to cash it in and do something else for your family with that money. And in fact, when I was 73 years old, which is now about 4 years ago, I turned in my life insurance, and I had quite a bit of it for my family. My wife doesn't work, I have a disabled son. But I figured out that if I lived for 10 years, I was better off dropping the policy and using the premiums for other benefits for my family. So that's what I did. Now I've lived 4 years. I got 6 to go. And Marty, you will know, if die within the next 6 years, I made the wrong bet. But if I live for at least 6 more years, I'm better off having dropped the policy. That's something you need to think about. It's something that you need to explain to your clients. And this sounds absolutely counterintuitive. We're not trying to get, we're going to pay the same premium, but we're not going to try to get the maximum death benefit at the beginning. We want the lowest death benefit, but overall the highest cash value we possibly can. I realize that's very counterintuitive. Mark and I did an article on this that appeared in Trust and Estates magazine a number of years ago. I think it's worthwhile you're reading about it, because I think your clients will appreciate you're really understanding how life insurance truly works. Let's go to our next slide, Marty.
Private placement.
Yeah, back to tax-free compound. I mean, Albert Einstein said a lot of things. He said E equals MC squared. Do you know what that means, Marty? I know it means, yeah, I don't know. But Albert Einstein said two things that I kind of understand. Number one, he said compound interest is the 8th wonder of the world. And the hardest thing in the world to understand is the income tax. So the corollary I derive is that tax-free compounding is the most important aspect of successful investing. And, do we understand investments? Well, there's a lot of complications. Many religions and societies prohibit charging interest. Although, Marty, as you may know, even if you're Orthodox or you're an Orthodox Muslim, you can't charge interest. But either your religious leader will say, but you can charge a fee. The fee happens to be equal to what the interest was, but you're not violating the rule, which says you can't charge interest. As I said before 1900, the concept of compounding just was not prevalent. How important is compounding? I don't think you can exaggerate it. And here are some illustrations. But Marty, let's go to a chart and take a look at what it all means. All right, now you'll notice this is a chart, and it has the first line we see there in light blue is 5% simple interest. We have 100 going to earn $5 each and every year. It doesn't compound. The next one we're going to have is 5% compounded. And you'll notice that we have now about 3 times more because it compounded every year. So over a working lifetime, that compounding factor is terrifically important. Do you or do you not want 4 times more when you retire? You certainly do. And with compounding, you get it. How about 10% simple interest? Are you better off, Marty, with 10% simple interest or 5% compounded interest? Well, if you take a look, you'll notice that the 10% simple interest beats the 5% compounded until about halfway to year 40. And then it switches. And by you get to year 40, you are better off with 5% compounded than 10% simple interest. But Marty, show us what we get with 10% compounded.
Rocket ship.
Holy moly. Look, we get 9 times more because we compounded at 10% a year. This is what you want. You want high returns, high earnings, and you want it to compound. I mean, take a look at the difference of what you'd have. Let's go to our next slide, Marty. I mean, to me, this is just absolutely magical. Go to the next slide, which is, a chart which is maybe a little bit easier to see. If you earn 5% a year, which we have on the left, you'll earn over 20 years, your dollar will grow to 265, but if you pay tax, it'll go to 219. So you suffered a 17% reduction in your wealth because you had an annual 20% taxation. If you earn 10% a year, you have more money. You don't earn 265, you earn 673, but with tax, it goes down to 466, which means you've suffered now not a 17% reduction in your wealth because of current taxation, but a 31% reduction on account of current taxation. If you earn 20% a year, you're going to have 30, and think about this, you start with $1 in 20 years because you earn 20% a year, you're going to have $38. I mean, that's amazing. My $1 grew to $38 in 20 years because I had a 20% return. But if I have to pay tax annually on that return of 20%, I'm going to lose almost half of my wealth. And if you could ever get that magical 30% return, your money would grow. $1 in 20 years grows to $190. That is breathtaking to me. But if I have to pay tax currently, I suffer a 61% reduction in wealth. So Marty, let's go to our next chart, which tells us that's an extraordinary event. Now, how do we reduce the income taxes? Well, you can go to a buy and hold investment philosophy, but for the tax-free step up in basis of death, assuming no change in the law. Of course, you may be holding something that doesn't always go up. In fact, Marty, do you remember they used to, what was that great airline, the greatest airline in the world after World War II? What was that called, Marty?
Pan Am.
Pan Am. Pan Am. How's that doing today, Marty?
Not so good. Not around for a long time.
Marty, how's Pan Am doing today?
Not so good, Jonathan. It's been
Not
gone
around.
for a while.
How about the greatest retailer in the world, Sears and Roebuck? How is that doing?
Not so hot.
Not so hot. No matter what it is, it will not always go up. In fact, you probably heard Jeff Bezos saying that he understands that someday Amazon will go bankrupt. So buy and hold can be a scary thing. You can try municipal bonds, but you're going to get a very low return. You can do qualified plans and IRAs. You could do Roth IRAs and stuff like that. Let's continue to go down, Marty. One of the problems is you can't get it out of your estate, which is an advantage. Remember the wild old accountant's adage, and Marty, you're an accountant. It's when a tax dollar delayed may never be paid. So, we've done the reduce the impact. And let's take a look at one other thing, and this is life insurance taxation. To have a policy of insurance, it's going to meet the definition under section 7702A, which puts in actuarial tests which you have to meet in order for it to be life insurance. And you've got to do that. Remember, life insurance typically has two components. It has a term component, like most of our insurance. You get paid only if the event you don't want to have happen, which in this case is death. The insurance company reaches in its own pocket and pays, and that's called the net amount at risk, because the insurance company is at risk for that amount. But the law permits them to couple it with an investment account, typically called the cash value account, but it's not kept in cash, it's actually invested. And the beauty is that the industry convinced the Internal Revenue Service many decades ago that the growth in the cash value shouldn't be subject to income tax, and it should be treated as part of the proceeds paid at death, so it's excludable from gross income under section 101A1. Now, if a policy fails one of those tests, one of those corridor tests, then section 7702G kicks in, and 7702G says that the annual increase in the net cash surrender value is includable in income for the year. So if I have a policy of insurance and it flunks the corridor test, one of these corridor tests that it has to meet compared to premiums paid, cash value, and amount of insurance. If I flunk those tests, which are very complicated actuarial tests, then it goes ahead and say, well, guess what? You're not a policy of insurance. But 7702G says it's only going to be included in income to the extent of the annual increase in the net cash surrender value, not gross, but net. Net means you can take it out. Now, suppose I get a policy which is called a frozen cash value policy, which I don't think any American company will write it, but there are some good offshore companies that will write it. So you still have the cash value grow, and it's growing entirely tax-free, but it's not going to be subject to tax because you can never take out more than the amount of premiums paid. You can take out the premiums paid, but you can't take out any more. Do you lose that increase in cash value? No, it'll be paid at death. So if you're willing to wait, you can completely avoid tax, even if you flunk the test. And why would you want to flunk the test? Because the premiums are cheaper, because the way 7702's actuarial tests are, you have to have a certain amount of real life insurance, term insurance, the net amount at risk compared to the cash value. And when you're younger, especially, those aren't very beneficial. When you're older, they're a little better, but the cost of that term insurance, the net amount at risk, goes every year, because the older you are, the greater chance you'll die that year. But that's one thing you can do. Now, you lose that tax-free buildup if you have cash value that's borrowed out and it's a modified endowment contract. But not if it's a Section 7702G policy. It flunks the actuarial test, but then you're going to have it to the extent of the increase in net cash surrender value. You could have the gross cash surrender value increase, but you're going to say you can't take out more than the premiums paid. Now, almost all large policies allow insurance policies, these so-called private placement policies, allow the insured to set up an investment arrangement, not just the insurance company wants, but on the selection of a manager of the policy. So I want to have a policy where I want my broker at Deutsche Bank or at Merrill Lynch or at JP Morgan choose it. That's okay. And that will be fine. And then I'm not stuck with what the insurance company chooses, and maybe I can get some really good returns. But in order to be one of these variable policies where the results are going to vary depending upon what the underlying assets do inside that policy, remember, we have a fixed death benefit, but the balance is going to be how much the cash value is, and that depends upon investment performance. And I think I can do better than the insurance company can. Go back one slide for a moment, Marty, if you would, please. Now, there's another thing that you have to worry about. And you know, then the question is, well, why aren't I making all of my investments inside a private placement life insurance policy? I don't have to pay income tax. I can cash them in, I can change them, I don't pay any out. Why do I want to do that? Well, one thing is you can't have direct control. You can't be the pilot in charge, and that's under the mysterious doctrine of investor control. This is a doctrine made up by the IRS, but unfortunately, it was adopted by the tax court in a fairly famous case in 2015 called Jeff Weber versus Commissioner. Mr. Weber had a policy of insurance. It's a fascinating case. I've written a couple of articles about private placement, about this mysterious investor control doctrine. And if you want them, we'll be happy to send it to them. But the parameters of when you fall under this investor control doctrine, when the owner or the insured is deemed to be controlling investments inside the policy, it's just not clear. But you will read, if you read the Jeff Glickman, the Jeff Weber case, you will see that the tax court said there were 77,000 emails between the insurance company and the owners or the guy who got the policy, Jeff Weber, and his lawyer and his accountant. By the way, that's not true. As I point out, he couldn't possibly have it. 77,000.
Jonathan, wasn't the Weber case a grantor trust? Do you think that has any bearing? Would you avoid this issue in a non-grantor trust?
Great question, Marty. Mr. Weber said, look, this isn't owner controlled. I don't own the policy. Yes, you can say I was controlling the investments, but I wasn't the owner. But the tax court said, aha, Mr. Weber, you had this owned by a grantor trust, and under the rules, trusts are ignored, and therefore it's treated as owned by you. Therefore, you are the owner, and therefore, since you or we find you to have controlled the investments, you're going to be taxed on the income as though the policy didn't exist. But we don't know. I would feel fairly comfortable if I created a non-grantor trust, as long as I'm not a beneficiary of that trust, and I then could give advice on it. But the parameters aren't determined yet. And as you will read in the articles, if you ask us to send them to you, that it's just not clear how much control someone other than the insured can have. I mean, policy on the life of my dad, but I don't own it. It's an irrevocable life insurance trust, which isn't a grantor trust with respect to me. And in fact, if my dad creates it, I could be the advisor to it, and it shouldn't cause a problem. But again, warning, the parameters are not set, and the IRS has changed its mind many, many times. Private placement life insurance is extremely complicated, but it makes sense. Now we're going to go through the situation of split dollar insurance. Now, split dollar insurance which we're going to go to the next slide, Marty, if you would, is something where you can divide or split the ownership between two different people, one who will own the risk of the net or term component, and the other one will own the cash value. And this has been around since World War II. I've done a lot of work in this area. The IRS has gotten very angry at me, but you know, I follow the rules, and split dollar insurance historically has sometimes been a very good deal. And there are now regulations under in the Internal Revenue Code, two sets of regulations, some under Section 61 and some under Section 78, 72. They are complicated. It is worthwhile knowing about these, especially if some of the changes which have been proposed in Congress come about. But let's go to another slide, Marty. And I'm not going to give the whole background on this. Go to one more, Marty, if you will. Yeah, the IRS, go back one, Marty. The IRS kind of, I felt, set it up for family or private split dollar insurance. Go back one more in Revenue Ruling 78-420. And I could tell you a long story about one of my favorite clients, Morris, who had a real problem. And I said, well, you know, if this stuff, according to the IRS, says it works in the corporate and partnership and business context, I think it ought to work in the family or private context. So Marty, go one more slide if you would. And then on the basis of Revenue Ruling 78-420.
Where are you looking, no? Jonathan? Here you go.
One more slide down, Marty. Yeah, there it is. Oh, the legend of Morris. That was my client. I did this. I began doing it for him, and I had 4 of our colleagues come to my office one day in 1995 and said, Jonathan, we understand you're doing this. And I said, yeah, I am. And I said, your logic doesn't matter, Jonathan. The IRS is going to come after you, hammer and tong. In fact, we think they may charge you with tax fraud. I said, well, let's find out what the IRS thinks. So I had a buddy of mine, Art Cedarbaum, who was a great friend of mine. I actually had him put in the request for ruling because sometimes the IRS is a little suspicious of what I'm doing. And sure enough, we promptly got back private letter ruling 9636033, which was an approval of split dollar insurance. And my dear friend Diana Zalo wrote a great article about it in the Journal of Taxation. She didn't even know I was the person behind all this. But they did it. And finally, when they came out with the final regulations on split dollar insurance in 2003, they actually used 9636033 as the way to do private or family split dollar insurance. It's worth your while knowing about that. Let's go on one more time, Marty, if we could, to a new slide. Here are 5 ideas for life insurance. One is, you may have an agent call you and say, look, why don't you create a grantor charitable lead annuity trust and fund it with life insurance, and you'll get a big deduction and you won't have a problem. The problem, when I heard about this, I just couldn't believe it, that no one had bothered to read Section 170 F10, which is the anti-reverse split dollar provision in the code. And it's a horrible provision. It basically says you are a triple loser. Number one, you're not going to get a charitable deduction for it, because when you create a grantor CLAT, you get a deduction for the value put in. Now, the price you pay is you got to pay income tax on what's earned. But the person said, but don't worry, because we're going to put it in a policy of insurance where there's no income tax, and we'll borrow it out. Well, that won't work, because under Section 170 F10, it's going to mean that you don't get the deduction. What's worse is you don't get the deduction for income tax purposes. You also don't get it for gift tax purposes. So you have this double-headed monster. So what could be worse than not getting the income tax deduction and then after paying gift tax on what you give charity? Well, even worse is the IRS can confiscate the assets. You don't want to screw up 170 F10 for sure. In addition, when you have a charitable lead trust and you make it a grantor trust, there can be recapture of the tax benefit under Section 170 F2B, and it can even happen with recapture at death under the regulation. So that's an idea. So shark fin CLATs, which is a shark fin CLAT, is one where you pay a tiny annuity until death, and then you pay this big amount. So the guy said, look, we'll just have you pay these premiums. We'll keep the amount that we owe charity, very, very tiny, $1 a year. And then when you die, then the big amount will come in, but it'll come in income tax free, and you won't have to worry about it because the proceeds paid at death are excludable from gross income under section 101A1, so you don't have any income tax problems. Sounded great, but when I heard about it, I said, my God, they didn't know about section 170F10. In fact, I wrote an article for Steve Lineberg, and the day it came out, the insurance company, which is a massive insurance company that promoted it, took it off its website, and you have great difficulty finding it. And I had a number of agents call me and said, am I going to be sued? And I said, no, if you're sued, don't worry, the insurance company will back you, but the IRS has not gone after anybody as far as I know. What are some other ideas for life insurance, Marty?
Well, you can, I'm not sure what you were getting at with this slide. Why don't you cover this and I'll cover the next one.
Well, Marty, let me ask you a question. I know you have a very wealthy uncle who loves you, and he's either going to leave you $10 million in cash. You don't have to worry about the stepped up basis, or he's going to leave you his $10 million Roth IRA. Which would you rather have?
Roth IRA.
This is unrehearsed, so I'm putting Marty on the spot. Which would you rather have, 10 million in cash or his $10 million Roth IRA?
Presumably the Roth, well, no, the Roth is going to come out as taxable. It's not taxable. So the Roth.
It's not taxable.
Stretch it out.
Yes, Marty wants the Roth. So that's absolutely terrific. So that's what you want. And how are you going to pay the estate tax on that, Marty, so you don't have to raid the Roth?
Life insurance.
Life insurance. It's another way to maximize the stretch, because if you have, I mean, most of my wealth, believe it or not, that will be includable in my estate is going to be in qualified plans and IRAs. So I would still like to get the maximum stretch, but if I'm lucky enough or the exemptions go down enough, I will have a taxable estate. I don't want to have my family in and basically raid my insurance policies. The way I can avoid that is I have a policy of insurance on my life, which will pay the estate tax, so we can take the maximum stretch for minimum required distributions.
But unless I'm an eligible designated beneficiary, isn't that pretty much capped at the end of the 10th year following death?
Well, Marty, it can be unless. And the big unless, Marty, is unless you have it paid to something like a charitable remainder trust.
Right.
So instead of uncle making, you know, it all payable to a, payable to a trust from Marty or outright to Marty, he would pay it to a charitable remainder trust from Marty. Now, there's a couple of beauties here. Even if it's not a Roth, it's just a regular IRA. If those proceeds are paid into a charitable remainder trust, Marty, how much income tax is going to be paid?
Not currently, as you pull it out.
It's not currently, you put it out. Income only charitable remainder unit trust, a so-called IMCRUD, we could postpone it for a very long period of time, possibly up to 20 years. And remember, the next best thing to avoiding tax is postponing tax. That's why we had that quote from the wild old adage, a tax dollar delayed may never be paid. So life insurance can really be helpful when you want to do that. Marty, suppose I do a grad, why would I want life insurance?
Well, in general, if you're doing 2-year grats, you probably view the mortality risk as pretty small. But like I said earlier in our program, in 2020 and 2021, when we were concerned that at any point in time, we would have a law enacted that basically eliminated grats, we had suggested that some clients at least evaluate doing longer term grats to lock in not only the historic low interest rates, but the grat mechanism, because that would have been eliminated in a number of the proposals to change the tax law. So if a client wanted to lock in the low interest rates in the grat mechanism before a law change, they may have done a 10 or 15 or 20-year grat. And if you're doing a tier of grats, let's say the example I used earlier, an 8, 10, and 12-year grat, you may buy an 8, 10, and 12-year term insurance policy. So if you die in the term of the grat, and just assume for argument's sake the whole principal of the grat's included in your estate, you'd have the insurance to cover the estate tax on the inclusion of a failed grat. And if you outlive the grat term and the grat assets are outside of your estate, then the term lapses, term insurance lapses, and you're done, and you've achieved your goal. So you could dovetail an insurance plan to backstop the mortality risk in longer term grats. And a similar concept would apply to cuprits, whereas if you did, and no one's really doing cuprits now because of the loss of basis step up and the low interest rates don't make it a very optimal technique. They work better in high interest rate environments. But if you have clients with cuprits, and we all did cuprits, when we had a lower exemption and different interest rate environment, if the client died during the term of the cuprit and you had a term insurance policy, that would have covered the cost of the estate tax on the failed cuprit. So you can use life insurance to sort of dovetail or coordinate with the other planning, just like you explained on the qualified plan. And
Thank you, Marty.
Should we go on to the next topic and try to wrap up soon?
Sure.
So here's just a couple of considerations of planning now. During 2020 and 2021, there was great concern that grats would be eliminated. And as a result, many clients made large gifts to their ILETs to use exemption, but not only to use exemption, but if you recall, we said earlier that Senator Sanders had proposed capping gifts, the annual exclusion gifts to trust at 2 times the annual exclusion. So, $32,000 under current law. So because of that concern, people pre-funded their insurance trusts. There was also a concern that if they provided that from date of enactment, any gifts to a grantor trust would result in a proportionate amount of that grantor trust being included in the estate. So for argument's sake, if somebody had 50 grand of gifts, 10 grand a year for 5 years to an ILET, and then post enactment, another 10 grand a year for 5 years, another 50 grand, and then died because half of the gifts to the ILET were made post enactment, half of the insurance proceeds would have been included in the estates. For all those reasons, many clients would have made large gifts to their ILETs in 2020 and 2021 to avoid all those different issues. So that's going to change fundamentally how a traditional insurance trust is done. We need to help identify those clients that made those gifts. They're going to need to invest the funds that were put into the ILET. You're not going to leave them sitting in a no interest checking account, which is typically all an ILET had. So they may need to set up a new account other than the checking account. There may be no need for annual gifts and crummy powers for many years to come. For the first time ever, many of these ILETs are going to have to file income tax returns because now they're having income earned on the portfolio inside the ILET, whereas in the past, the typical ILET had $100 or something nominal in a checking account. They'd make an annual gift, issue crummy notices, and then pay the premiums. Or as Jonathan suggested earlier, because of Turner, they could just simply pay it directly and not worry about the notifications under Turner. But now all that may have changed. So we really need to look at these insurance trusts and guide clients on what to do with it. Now, there may be, based on some of the discussions that Jonathan suggested in terms of the tax benefit inside the insurance envelope, it may make sense to have the insurance consultant evaluate if I have an extra $100,000, $200,000, $1 million inside of an ILET to be used for future premiums. Is it advantageous to pay those premiums now and put it into the policy or invest it outside of the policy? There may be an advantage of putting it in the policy, but you need to take a look at that. Another consideration, which sort of plays back to Jonathan's illustrations of the income tax advantages of growth and earnings inside of the tax favored insurance envelope. The House passed its version of Build Back Better. It had included a surtax on trust income that for income of over 200,000, there's a 5% surtax, and over 500,000, an 8% surtax. If these surtaxes are enacted in some future variation of a Build Back Better, and you know, at this point it may seem unlikely for anything to get enacted, but we just don't know. But if those surtaxes are ever enacted, the use of insurance to avoid the income tax inside of trusts with investment assets may be very useful. And there's some other flexible beneficiary planning options which might be able to be grafted onto trusts, but insurance is certainly another option that is worth considering. One of the other things in the current environment, don't forget, with all the talk that's now, you know, perhaps gone of restricting and making the estate tax harsher as proposed in 2020 and 2021, if there's no changes made, which is certainly a possibility, in 2026, the exemptions, the gift, estate, and GST exemptions are cut by half. So it's still, in the current environment, very much behooves clients that can to use exemption before the exemptions drop. Now, many clients that did planning in 2020 and 2021 are not going to be comfortable making further gifts. Many moderate wealth clients don't have enough resources to use up all of their exemption or even most of their exemption. For some of those clients, it may be advantageous, and Jonathan hinted at it, but we didn't discuss it, may be advantageous to take existing insurance trusts and allocate GST exemption to them. The reason a lot of clients did not allocate exemption to insurance trusts was in part because there's a fairly large lapse rate for insurance policies. Term insurance policies, I think the lapse rate is so large that only about 2%, maybe under 2% of term insurance policies are ever paid. So if you had this precious commodity of GST exemption, why would you risk allocating it to a trust that holds a term policy if 98% of them are allowed to lapse and don't pay off? But in the current environment, for clients that are under the exemption amount and have excess exemption, that may be a very useful way to use up exemption. So what it might entail is one option is to take the existing insurance trust that was probably not optimally done if it's an old style trust that maybe paid money out to the kids at age 30, 35, some fixed age, and first allocate GST exemption, a late allocation of GST exemption, because they have no other use for it, to the old ILIT, and then decant or merge the old ILIT into a more robust SLAT that they may have already created in their 2020-21 planning. Now you have one less trust because you've gotten rid of the insurance trust. The insurance trust effectively now is GST exempt, and you've traded or converted an old style inefficient payout at some specified age trust into a trust that is more modern and will hold assets for as long as permissible. Another approach to dealing with the old insurance trust is the old insurance trust, instead of making a GST allocation to it, especially if there's no exemption to allocate, might be able to sell the insurance policies that it holds to the more robust SLAT, grant, or trust, and thereby freeze the value in the old ILIT. The sale may be done for a note, and you may actually just distribute the note back to one of the beneficiaries of the insurance trust and get rid of the old insurance trust. Now the insurance is in a GST exempt perpetual trust, which is perhaps a much better result. We've even had clients, because they've had exemption remaining, more moderate clients, where when that note comes out to them, we've had them gift that note to their trust. For example, if it was an insurance trust with insurance on the husband's life, that trust sold the policies to the husband's SLAT for a note. The note was distributed to the wife, who was a beneficiary under the traditional old style ILIT, and then she made a gift of it to her SLAT just to get it out of her estate. The old insurance trust is gone. Everything is now in GST exempt perpetual trusts. So there's some creative planning that could be done. Just a couple of quick comments, because I know we're out of time, on SLATs and insurance. One comment is that one of the real issues with traditional SLATs, and I'm sure there were a lot of these done, is that if I create a trust for my wife and she for me, if she dies prematurely, I lose all access to the money in the trust that I created for her. And that's one of the reasons that using a more robust approach, like a special power of appointment trust, a so-called SPAT, a hybrid DAPT, domestic asset protection trust, or DAPT if you're comfortable, may have made more sense. But no question that a lot of the trusts that were done over the last couple of years were all done as more traditional SLATs. So insurance can help address the mortality risk that I just described, and that was one of the benefits of an insurance policy that we talked about early in the program. But I think it really behooves all of us to go back to clients that did a lot of the SLATs and other irrevocable trust planning over the last couple of years and look at the mortality risk and other issues. Now, I'm going to make a statement that, Jonathan, you may not agree with, others may not agree, but if a SLAT was created in 2021, I believe that one of the things that makes the reciprocal trust doctrine an issue is if the parties are left in a similar or same economic position after the creation of the trust as before. So if I put $10 million into a SLAT for my wife and she puts $10 million in a SLAT for me, unless there's significant differences in distribution powers, powers of appointments, etc., we're in a very similar position economically. What if you take and one of the trusts bought a $5 or $10 million insurance policy and the other trust did not? That may be enough to help differentiate economically. And if it was a trust certainly done last year, this may be part of the same plan. So it may actually help with respect to not only mortality risk, but with respect to the reciprocal trust doctrine. And I think some people may disagree with that, but I think it certainly can't hurt and it may help. Now, one of the key issues with the planning, and then I'll conclude with a final insurance comment, is to make sure that we preserved access to the assets in these trusts, because for many clients, they really needed access. Insurance can fill some of the gaps, and forgive me for the typo on slide 53, but life insurance, as I explained, can address the mortality risk of premature death. But there's other insurance needs that could be looked at that can help backstop the SLAT plans that so many of us put in place over the last couple of years. If a client is in their 50s and they put $12 million, 11.7 into a SLAT last year in 2021, it may be that they're assuming they have another 15 plus years of work expectancy and that they're going to live on their income from work. But what if they're disabled? Was that factored into the planning? It may make sense not only to look at the life insurance for mortality risk, but to make sure that the clients have reassessed their need for an amount of disability income replacement coverage, because if there's a disability and that work expectancy is cut off, it may change the economics and the need to access the SLATs and affect the couple adversely. So that's certainly worth looking at. For older couples, it may make sense to take a look at long-term care coverage, even if they otherwise wouldn't have considered it. We all saw lots of clients put very substantial percentages of their wealth into irrevocable trusts like SLATs and other mechanisms to use exemption before the exemptions we feared would have changed and grantor trust rules would have changed and so on. Long-term care coverage may have some new meaning in that context. So those are some of the ways that we need to take a look at insurance in the current environment. And a lot of those ideas tie back to some of the things that Jonathan explained earlier. Jonathan, do you want to make any concluding comments or remarks?
Well, Marty, I thought your points you made for the last few minutes were very important, and I think you're giving great advice on it. And Marty, I didn't disagree with anything you said. It was great being on this program. Again, life insurance, I find, even though I don't sell it, and even though I've dropped my insurance now, it is a fascinating financial product. There's nothing like it. The insurance companies have been extremely effective in building a product. It has wonderful tax attributes. And I hope you've enjoyed the program. I certainly enjoyed being part of it.
Thank you, everyone, for joining us. And there's email address information if you have any questions. And wishing you all good luck. And I think the take-home point is that insurance is an incredibly flexible tool and can offer incredible ways to enhance the planning that we're all doing. And I encourage all of you to take a look at it, especially for the planning we all put in place under such time pressure in 2020 and 2021. Good luck, everybody.